Federal Reserve certainly has its hands full as it attempts to land the economy smoothly while avoiding a recession. I think risks to the economic outlook are higher today than they were 6 months ago, but by no means is a crash landing our base case scenario. I think rather the economic outlook is cautiously optimistic, but certainly as we navigate these potential challenges ahead, vigilance is certainly necessary. And the Fed certainly continues to keep its eye on economic conditions, really aiming to ease policy and lower interest rates over the next couple of years. And I think since the Fed has gotten so much attention lately, I thought it would be good to highlight the Federal Reserve's dual mandate, which is maximum employment and stable inflation. By adjusting short term interest rates, the Fed can stimulate a sluggish economy or cool down an overheated one by influencing lending and borrowing rates. This recent quote from Jay Powell, the chairman of the Federal Reserve, I thought summed up economic policy quite well. He said the time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. So it's evident that the Fed feels the time is right to begin lowering interest rates, but I think the timing and the pace of those cuts is highly uncertain.
So the Federal Reserve is trying to strike this balance between full employment, stable prices. What are the most meaningful aspects of the economic landscape our policymakers are paying attention to as they craft this plan?
So there's a wide range of data that the Federal Reserve is monitoring, but I'll just highlight a few of the key areas. The first is inflation. Inflation impacts everyone in the economy, including workers, businesses, and people on a fixed income. If you remember, it was just a few years ago that inflation peaked at over 9%. Because of the Federal Reserve actions in 2022 and 2023, 1 year ago, inflation was 3.7%. And more recently, it's actually 2.6%. I know this chart shows 2.4, but we had an inflation release just over a week ago. If we look at the underlying components of CPI, most are stable. The one area that continues to put upward pressure on the overall inflation rate is housing or shelter.
What about the employment side of the equation? We've talked a lot about inflation over the past couple of years, and more recently, it seems like the unemployment data is starting to really catch people's eye. Where do we stand on that?
So the unemployment rate is a key indicator of consumer health. The current employment landscape is actually relatively robust with an unemployment rate of 4.1%, especially when you compare that to historical averages. It's the quick move higher we've seen over the past year from 3.8% to 4.1% that's really caught the eye of the Federal Reserve and certainly has played a role in the recent rate cuts. Now, the significance of a healthy job market to the consumer cannot be understated. So it's reasonable to anticipate the Fed will act quickly to counter further declines in the employment levels.
So inflation is lower, unemployment is up modestly. What are we seeing in terms of real economic growth in the United States?
The gross domestic product, or GDP, really serves as a broad indicator of health and growth. There's many factors to consider when assessing the growth picture, such as consumer spending or government spending, or even the geopolitical tensions, to name a few. With quarter over quarter GDP at 3% and showing an encouraging trend higher from a year ago, it's safe to characterize GDP growth as healthy and not signaling signs of an imminent recession.
So, John, you mentioned that one of the items on a lot of people's mind is the impact of housing, as it's a big part of that inflation piece. As we've started to see short-term rates come down modestly and some things start to shift in the economy, are we starting to see some loosening up on the 30-year mortgage rate?
Well, unfortunately, the decline that we've seen in year over year Treasury rates has not significantly moved the 30-year mortgage rate to any great degree. Now, it's important to note that there's a multitude of factors that go into setting mortgage rates. It's not simply Treasury rates alone. Now, in addition to rates, supply has also been a big factor in keeping this housing market inflated. These higher mortgage rates have helped freeze existing homeowners. Almost 80% of existing homeowners have mortgages at a rate below 5%. So it's really likely that mortgage rates need to get into that 3 to 4% range to really entice existing homeowners out of their current homes. And barring a complete economic meltdown, which isn't our base case, we're not going back to those low mortgage rates anytime soon.
You've spoken about the importance of the US consumer. How does the US consumer impact this overall economic picture, and how healthy is the consumer right now?
Well, two-thirds of our domestic economy is driven by consumer spending. So a healthy consumer is vital to continued growth. And one way that we can measure the health of the consumer is the personal savings rate. A low savings rate can really leave individuals vulnerable to financial shocks such as job loss. The 20-year average of the personal savings rate as a percent of disposable personal income is 6%. So the trend lower that we've seen over the past year from 5.5 to 4.8% leaves us a little bit more cautious on the US consumer. Now, moving forward, the two biggest threats that we see to the consumer are a resurgence of inflation and employment. Keeping prices down and maintaining a job is essential to a strong consumer.
So, John, when we take this economic dashboard in totality, and the Fed is starting to think about how they can shift policy, what are the real impacts on the interest rates that we all experience?
Well, the Federal Reserve's interest rate policy plays a crucial role in shaping the US Treasury yield curve, which reflects the relationship between interest rates and the maturity of government debt securities. This graph you're seeing represents the current US Treasury yield curve. Now, the highlighted gray area indicates that the Fed directly affects short term yields. Now, longer term yields are really driven more by market expectations about future economic conditions and expectations about future Fed policy. Now, these longer term Treasury rates are really important to you and me because they act as a benchmark for other debts in the market, such as bank lending rates and mortgages.
So, John, where does the Fed think that rates will go from here? What are they telling us they are expecting?
So each quarter, the Federal Reserve publishes their expectations for short term rates. Traders in both the bond and equity markets closely analyze the forecast and compare current estimates versus previous ones to look for any changes that could indicate shifts in the Fed's stance on interest rates. The shaded area here shows that the Fed expects to continue reducing policy rates over the next few years. Now, a slow, methodical move lower by the Fed would lead to lower short term yields, while long term yields remain more unpredictable from here.
So, John, there's one question we hear every year from our audience. And in fact, it was the very first question that popped up on our Q&A here today. So I'm glad that we can address this head on. Let's talk a little bit about the US deficit and the total government debt. What are your thoughts, and how do we address this concern about the large size of the US government debt?
So I heard this great quote from David Rubenstein just last week, and he's the founder of a private equity firm on the East Coast. And he said that the debt and the deficit is like the weather. Everybody likes to talk about it, everybody has an opinion on it, but no one is able to do anything about it. So, to kind of set the tone here for where we stand with the current debt and the deficit, according to the most recent data from the Congressional Budget Office, the US has $35 trillion in debt outstanding. The US government continues to add to this debt, resulting in a $1.8 trillion deficit in the current fiscal year, which represents over 6% of GDP. Now, the interest expense alone on America's debt now exceeds our defense budget, and soon it will also exceed Medicare. So, this persistent deficit and high levels of debt are really a dark shadow over our markets. And one of the concerns that we have is that a rising deficit can really alarm investors about the government's ability to manage its debt which might lead them to require higher interest rates to compensate for the added risk. Now, any upward pressure that we see on rates would make it more expensive for individuals to borrow money, and this can ultimately impact the long-term growth of our country. Now, sustaining such a large deficit while the unemployment rate is at multi-decade lows is unprecedented. Consider the recessions of the 70s and the 80s. The US was in a very similar fiscal situation as it is today, yet the unemployment rate in each of those time periods was nearly double what it is today. So today's low unemployment rate really supports a strong consumer who ultimately continues to spend and really encourages modest growth, which should help narrow the deficit. Now, I realize that this is not the rosiest of pictures here, but if we can look a little bit more forward, the path to reducing the deficit can go a few different directions. The first of which is to grow our way out of it. The spending that we have today on the infrastructure, education, job growth, to name a few, can really drive economic growth in the future. Now, second, this new administration, which will be in office in less than 2 months, potentially could they find ways to cut spending? And finally, the potential for increased revenue via tax reform could help. And I'll let Jason touch on that whole piece here in just a few minutes.